Welcome to today's video. Here we are going to discuss a very interesting strategy called Batman strategy. It's a very fancy name for a strategy. Today, as we record this video, it is 10th of May, and here we have the graph of Nifty in 15 minutes time frame. Already we have discussed bull call spread, zero loss strategy. If you haven't checked that, please do check that video first. And in this video, I'm going to dedicate it purely for option buyers. A lot of times in the group, the community members ask me, sir, is there anything that I can do in order to make sure that I remain profitable in this choppy market, right? Like the market is going up, down, and there is a lot of randomness, a lot of spikes, eating away all the profits that they have done through the day in one single candle. So this is going to be the order of the day for May month because we are waiting for election results, and then most likely the results would be the deciding factor for further course of move. Sir, until then, what can I do? I am dependent on my livelihood for this, and is there something that I can do? I'm going to dedicate this entirely for option buyers, pure option buyers. But when we say a zero loss strategy, it cannot happen without an element of writing. Let's be very clear with that. So this is not a clickbait, or this is not some sort of false promises that we make here. And right from the beginning, I'm telling you, it is going to involve some amount of writing. So you may be saying that, sir, I have a very small capital, only 1 lakh or 2 lakh. How can I go for writing? Writing is for big players. No, it's not so. You should know how to manage your funds, and then you should know what sort of hedging would lower your margins. And that is what we are going to learn from this video. Upright, I can tell you, the margin requirement for this strategy will be less than 80,000 rupees. Okay. So if you have 80,000 rupees, what is the money that you can make in next 45 days? That's what we are going to learn. And right now you see that the market has, taken a dip, and then it retraced, again a dip, again it retraced, again it took a dip and then retraced. Currently here, you never know whether it is going to go up from here or it's going to further go down. Nobody can predict that, but we know that there is going to be some movement in next 45 days, correct? Market will not be staying here. It will either move or up or down. So how do I, as an option buyer, take advantage of it? And can I deploy this strategy in all market conditions? Of course, yes. The main requirement, the prerequisite for this strategy is patience, nothing else. Okay. First of all, I will show you why it is wrong to do this in a weekly expiry, and why you should be doing this in a monthly expiry, or even better, further 1 month away expiry. First of all, I will take you through the weekly expiry and show why this is not a good strategy. So here we are in Upstart, and let's say this is an option chain stimulator. So this will be, the data is available for 9th of May, which is the recent expiry. So we don't have any other data to refer to. So for that reasons, supposedly on 2nd of May, because first was holiday, second was the working day, right? So if we initiated the strategy on 2nd of May at 9:16, what would have happened by 9th of May is what we are going to learn from this. And currently you can see that the spot price is 22,650 almost, right? So I'm going to 22,650. This is where it is. In this strategy, it involves buying of a call option as well as buying of a put option. So what you are saying is only a short straddle, long straddle. Yes, it is a long straddle, but then if you just look at the payoff, it will be like losing money anywhere. If the market ends in between, you will be losing money. So how do I eliminate that? So I have sold this for close to 180 rupees. Sorry, bought it for 180 rupees. I paid the premium on the call side, paying 178 rupees. Now I go to the nearest closest value half of it, which is about 90 rupees. Which one is about 90 rupees? Let's say 101 rupees is what I wanted to write. Although it is a bit more, but still, let's say this is the closest available. I am selling two lots of it. Remember, one buying of ATM and two sellings of half of its value in FAR OTM. Okay, I did this. Now, again, what is the premium I paid on the put side? 132 rupees. So, what would be half of its value? So, that would be around 65, 66 rupees, right? So, here we have almost there. So, I am taking two lots of this. Now, with this, if I go and check, this is how my payoff looks like, right? And you may be wondering, sir, what is the margin required for this? Since you have a buy position and two sell positions, you got to buy one edge, one single lot of edge you got to buy. Because two lots of buying requires two lots of, two lots of selling requires two lots of buying to reduce the margin. And where should I take? Should I take another call at the money? No, you should not be doing that. You simply look at the break even over here. This is very clear, 22,200 and 23K almost, right? This is the strike that I should take, right? Now, if I go and then say 22,200, where it is? Here, this is trading at 28 rupees, pretty expensive. Okay, let me buy, but this is two lots, right? I wanted to buy only one lot because we already have a ATM put option purchased. Now I took this and 23K I have to go and see what is the premium, 40 rupees. This is again expensive. Still, I'm taking it. Now this position is very well edged. What is the profit and loss? Max profit is 4K, max loss is 2,200 rupees. Now this is the strategy, and if the market stays at the same place, then we will be losing somewhere around 800 rupees or so, or 900 rupees, right? Sir, where is zero loss in this? That's why I said you should not be doing it in weekly expiry. Having said that, let's say that we have taken this position and see what would have happened. Since this is not our main focus, I am going to keep it in 30 minutes time frame and then update it for every second, and then let's see the payoff, how it looks like. I'm going to keep the charts here. You can look at the payoff over here. It will show the value when I click play. So I'm going to start it. So we are incurring small profit or some small losses. There are no significant thing happening over here. You see 200 rupees, 300 rupees we are able to just make, but it's not worth it, right? Why should you wait for a week to make 300 rupees or 400 rupees? It's not a good strategy then. Having said that, let's say at least if it is giving us a return of that 4,000 that it claims, right? That one we should check. We are on 7th, 8th. So 9th, this is the last day. What we are making here, we are at a loss of around 2,200 rupees. So even if we go to the, see, this is only 3-1. Even if I wanted to go and check what happened till the end, now what is that loss we have made? So we waited for one whole week to make a loss of 2,200 rupees, having deployed close to some 80,000 rupees. How do I know what is the margin? I have checked it in strategy builder. You can use sensible, add this position and see what is the margin requirement. Since we are in this screen, I don't want to really switch and then add the same position again and waste time. So this strategy didn't work out well on a weekly expiry, right? Because these days Nifty is making a move of easily 100 points just like that. And last couple of days, you can see that there is 200 points, 250 points of move, just like that it is moving, right? Either direction. So when we initiate this position over here, we have a coverage of only around 400 points. And in 1 week time, who knows? It can move 600 points as well. So we are not able to make money in a weekly expiry. Now, this is what I am proposing. How we can make this work for us. Sir, every day I am trying to make some money from the market, but then eventually I am losing it. My brokerages are going up. I'm unable to, even if I get the direction right, I enter at the right moment, the candles are just reversing without any warning. I'm losing big time. My confidence is going down. So many stories that I keep hearing. For all of you, this is my dedication. I am dedicating this strategy for all the people who feel that in this market, it's very difficult to make money. Please do watch carefully what we are going to do. What I propose is we are going to go for far away expiry, right? Typically 45 days to 50 days away. So since the back data don't have any expiries, I'm forced to select this 25th of April. Okay, if 25th of April is the expiry that I am choosing, then 50 days before that is somewhere April 25th. Then this is 25 days, and then I am going back another 30. So, oh yeah, okay, let's take 1st of April. Okay, let's take 1st of April, and then I wanted to see the payoff for 25th of April. 25th of April. Here. Now this strategy doesn't make any sense, so I am just clearing off all. This is weekly, so it makes no sense. I am deleting all. Now I am going to add the same thing in a monthly contract. Okay, so here the spot is, you see, 22,100. So I'm going to, we always initiate with respect to the spot, not with the futures. Remember that. So spot is at 22,100. I'm going to 22,100 now, which is trading at 652 rupees. So I'm adding one lot of this. And what is that we have to do? We have to go and put again one lot of this. All right. So you added one put, one call, both you added. Now, what is the premium that you paid for the put? 652 rupees. If I divide it by 2, almost like 375 rupees, something I have to find. Where is 375? We don't have a 375. It's okay. Let's say I choose this 436, about one lot, and then I don't want to really split it and confuse you. Maybe for the video purpose, I will keep it both same strike itself so that you don't get confused. What I have done is I have added 2 lots of call writing over here, right? 436, 436, right? Then, so I collected more premium than what I paid, right? And here I go, and then I see 380 rupees. So 190 rupees is something I need to look at. Here I have something at 190 rupees. Fantastic. So I'm going to do 2 lots of this, add it. Now, how does the payoff look like? It looks like this, right? Now, 1 lot of buying and 2 lots of selling for the equal or slightly more premium than what you paid. Okay, that's what you should be doing. Because if you write more closer, then your chances of making big money will reduce drastically. The farther that you write, the more money that you will be able to make. But in the interest of also saving no making it into a no loss strategy, we are choosing exactly half of its value or around nearby that, right? So this is how you create it. And where is my break even now? I got to check that. If I see it is coming to 20,700 and 23,100. Now I am going to weekly expiry, right? So since this is 1st of March, I have to choose 7th of March. That is the current week expiry, right? I am choosing that. And what is the 2,700? I'm going and seeing what is 2,700 price. It is 1 rupee 90 paise, right? 20,000. So this one I am buying one lot, and I need to see where is the break even on the upside. Just wanted to just let me delete this. So and choose April 25th. Yeah. Where is the break even? 23,100 and 2,700. So 2,700 and 23,100. Let me go to the weekly now and buy. 23,100 is trading at 2 rupees. Add one lot of it. Done. Then 2,700, 1.9 rupees. Add one lot of it. Why we are buying this? This is only to reduce the margin money, nothing else. That is only to bring your capital deployed by 30% lower. No, nothing else it's going to do. It has no significance, right? So this is what it looks like. But it messes up with the payoff, right? It messes up with the payoff. You will not be exactly knowing whether you are making money or losing money because weekly contracts are added. So the strategy builders will not be able to compute exact profitability for a calendar spread. If you're having positions of different expiries, it will not be able to compute. Just for your analysis purpose, I am showing you this, but every week, for example, if it is 7th of March, then you need to close and take the same position, 23,100 of call and 20,700 of put of next week expiry, which is 14th. And once that week gets expired, then you take 21st. Same strikes. You just keep repeating till the expiry, which is 25th of April, right? Now, that is only for the margin management. I'm going to delete this leg now because we don't need an edge. We don't want the charts to be messed up, and wanted to show you what happens exactly when you take this position and run it through till 25th of April. And I'm going to set this as 25th of April. So this is the original payoff graph looking like, right? And this is the strategy. Assume that we have edges of 20,700 and 23,100 all the time. For every week that expires, you got to buy a fresh one for the next week, right? So that is the only thing you might have to keep track of, and that is only for margin management. Now let's see what happens with this strategy with 30 minutes, with each 30 minutes passing, whether we are making money or losing money. That's what the strategy is all about. I'm going to click on play. So let's see if it really works for us or not. So almost 4K loss. Now we have come back to like 500 rupees profit, again getting into loss of 2,500. It keeps changing. As time passes, you will be making money. So let's see if we are able to make money in this strategy or not, right? 6th of March, 4,000 rupees loss, 3,000 rupees loss. $1,500 loss, 145 rupees. We are never in profit. Just now the profitability began. So still a lot of time to go, right? Like April 25th, right? So, and you can always make choices whenever you feel that this level of profit is enough for me. I waited for about 10 days and this is the kind of return it gave me. I'm happy with this. Then you can choose to book it. But let's say that you waited till the end of month. What would have happened? That's what we are going to analyze. So 9K profit is good. Close to 11K. 12K. So one of the important thing about writing positions, whenever you club a writing position, initially you will be seeing losses because the market moves, you will be in loss. But the moment profitability hits, very rarely you will see it getting into negative. For example, first 10 days, it was always in the negative side, barely entering 500 rupees profit or something like that. Now you see the profits are standardized somewhere around 11K, 12K. It is like getting regularized unless we see some sort of dramatic fall or dramatic rise. This profit holds good, right? So 26th of March, it is 14,000 rupees. Now tell me, you are making 15,000 rupees for a capital deployed of around 75,000, right? 70, 75,000. Let's even keep it like 1 lakh, okay? 15% return it is, right? Profits coming down, 10K touched once, now 9K. $11K it is holding on. That's pretty good. So we have entered into April 2nd, another 23 days to go. So this is all like your decision making moment, whether you want to stay in the trade and then wait for more profits to come, or you are happy with it, you want to book and then take a fresh position for the subsequent month. It's all your choice, right? So let's observe what happens if we waited till the expiry date. I'm going in 30 minutes time frame because I don't want to miss out any event in between if there was any sort of spike and did we ever get into loss. I don't want you to miss any of it. So we are going every 30 minutes time frame over 50 days and see if the strategy was ever into any loss after the initial losses that it proposed. 7K, because market is skewing towards one direction, you see the profits reducing. Still, it's 10K, giving you 10K. Quickly back into 12K because there was a weekend and then break in between. Now it is back to 14K again. Even though the market stayed there, there was significant erosion, right? Now it is showing 18K profit. Fantastic. As time passes, you are making some good money. This is possible only when you are doing writing. When you are clubbing it with writing, that's when it is possible. 21K we are able to make there. 21K, imagine, you are, even if you keep it as 1 lakh as the investment, this is 21% returns. Can you really, make 21% in buying in a month? I doubt so. I don't think anybody could be consistently making such money. So let's see how profitable this was on the day of expiry. Is it really worth it? $22K. Almost there, just 2 days to go. 23K. 24. 25K. This is the last day. It's going to expire. There we are. Another 14 minutes left. Let's go and check it manually. Then the day of at 3:30, 27,450 rupees. That is 27%. Even if you keep 1 lakh as the investment, how many lots? 1 lot of buying on both the sides, 2 lots of writing, getting you 27% return. Now tell me, if you trade for 50 days with a capital of 1 lakh, will you be able to make 27,000 after paying all the brokerages, trades that's gone right, trades that gone wrong, and slippages, and all the algos, and all the stress that you go through? What stress we had? We just created the position, and then 50 days later, it's giving you this return, right? So this is one fantastic strategy. This can be a game changer. Now, for June month, right now the question is, sir, okay, in the back testing it worked. What can be done today? As we are talking, the market on 10th of May, market is still running on, and then what should I be doing? Then this is what I would suggest. Let me just change. I think we should select strategy builder, and then I'll show you here. I can show you with the margin requirement as well. Currently the market is trading around 2250, let's say 2250, and I am clicking on the option chain. 2250 is over here, right? And I wanted to go to not May month contract, but go to June end contract. This is the contract I wanted to play in, and then I'm going into options market. So 2250 is over here. That's a spot, right? Yeah, spot is spot on, correct. So I'm choosing 2250. One lot I'm buying, right? And then 2250, one lot of put I am buying. Now what is the premium that I paid for 2250? 715 rupees. So almost like 720 means 360 rupees I have to look at. Which strike is trading around 360 rupees. I like 384 because there are brokerages on brokerages, and then edges we are taking some 20 rupees extra I wanted to keep as buffer. So I am keeping this and selling it 2 lots, add position. And here, what is the premium that I paid for 2250? 524 rupees. So 250 and 262 rupees. So which is trading around 262, 275. I'll take this, two lots of this. I'm going to add. Now, if you look at this payoff, it looks like this, and it's a net credit. So you are not paying anything from your pocket. You are instead receiving 2000 rupees for taking this position. And what is the margin required for this? 71,000 rupees. See, even without an edge, it is showing only 71,000. Now, can I reduce the margin? Yes, definitely. I'm going to current week. Before I go to the current week, I wanted to check what is the 20,300 and 23,500. Let's say 20,300, which is 1 rupee. Let's say that even if I am taking a 2 rupee, 3 rupee, let's say even if I am taking a 3 rupee one, just to show you how much you can really go with the strategy. And 23,500, right? 23,500 is 1 rupee. I am going and taking something at 3 rupees. Okay, here I am buying another one lot. Now, I am adding this only to show you how much margin it has reduced to. See here, it has come down to 44,000. 45,000 is all you need in order to initiate this position, and keep buying these edges alone later. These edges alone you got to buy again and again and again for 8 weeks maybe. Say from today there are 8 expiries. 8 weeks you got to buy this 2 rupee, 2 rupee, 2 rupee. Ultimately this one doesn't matter, right? So if I uncheck this, what can happen? I will just go and show you select the payoff. I'm going to June 27th. That is the payoff date. Here, what is that money I can make? 22,000 rupees over here. If the market goes up, I will be able to make 19,000 rupees if market is reaching near 22,700, right? These are some of the best ways to remain profitable. Say that the election results are positive and then market moves, say about 1,000 points, you are in profit. But after the election results, market will not just simply go up, it will also correct and then come down. If the market results are, the election results are bad and then it's going down, it will go down for a couple of days. Again, it will come back. Anyway, even if it goes beyond, you have edges of 2 rupees, 3 rupees protecting you. So on the downside or on the upside, you are not going to lose anything at all. To be frank, you will not be losing anything at all. We are seeing this graph without any sort of edges. That's why it is showing unlimited loss. But remember, we always have these legs enabled. But the moment these legs are enabled, you will not be, the graph gets messed up, which is why we are not adding it. And you can also do multiple ways of adjustment to this. For example, market has taken a direction. I'm just going to select the payoff for 27th. Okay. Here is the payoff. So this is how it looks like. Now, if the market say that it has moved up and it is on a bullish run, sir, what if it crosses further, right? You may be wondering. Then close this leg on the put side, shift it. Say the market has moved by 1,000 points. Okay. Now this one has become almost nil. You don't get anything from the here. Now shift it by 500 points or something like that, and then do the management. Use some sort of sensible strategy builder or Opstra to manage your positions. So this is not like you do one time and then forget it. If something goes wrong, then you should also know how to do the adjustments. But even without adjustments, this is the bare minimum need for any adjustments, because you are not expecting very big profit. You are just looking at something very reasonable. If the trade goes right, you are going to make somewhere around maximum 21%. Not even 21%. I cannot call it 21%. I assume the margin to be what? 1 lakh. But what is the actual margin here? 45,000. Let's say 50,000 rupees. If 50,000 is the margin and you are making 21,000, which is what 40% return, right? So you got to be really happy with the kind of payoff it is showing. And this is called Batman strategy because you can see that it has the shape of Batman, right? The face mask. So that's why it's called a Batman strategy. And this is the closest to zero loss strategy for an option buyer. I won't say this is 100% option, option buyer strategy. There is some element of writing, but the writing is affordable for an option buyer, even with small capital. That's why I call this pure option buying strategy with zero loss risk. So I hope this video was helpful, and please do share your comments and what is the next strategy that you would like to learn. Post it in the comments. I will definitely do it. All the very best. See you all again in another video.